Welcome, everyone. Thanks for joining. On this episode of the Joseph Carlson Show, I want to do something a little bit different. Normally, we talk about a variety of different subjects. We might go over different news stories and answer questions. On this episode, I just want to talk about one subject, one company in particular, Apple. I want to explain why Apple is my top holding. I want to explain why I'm buying more and more of this company at its current price point. In fact, if we look at my activity feed in my brokerage, we can see that just yesterday I bought $2,000 worth of Apple, and then today I bought an additional $4,000 worth of Apple. I've been buying this company more aggressively as time goes on, and in this episode, I want to explain why. I want to explain in depth my entire bull case on Apple, what I see as the risks, what I see as the potential reward, what I see as the future of this company, and I want to address some of the common concerns. That Apple is now expensive because it expanded from a 15 PE ratio to a 25 PE ratio, or that Apple is facing problems with the Apple versus Epic trial. I want to go over those issues as well. So this episode is going to be an in-depth look on why I'm buying Apple, why I think it's of good value in the market right now, and the future of this company. Now, before jumping into this bull case and why I'm buying Apple so aggressively, I have to mention something first. This channel recently reached 200,000 subscribers just a day ago, which is incredible given the fact that we are at a little bit above 100,000 at the start of this year. So the growth has been incredible, and I just wanted to first really say that I sincerely appreciate everybody that subscribes, that joins along in the journey, that shares the channel, that enjoys the content. I appreciate each and every one of you. It's an opportunity to be able to do this as a YouTuber. I'm grateful for the opportunity, and I don't want to take that for granted. So I hope you're enjoying the content. I want to make content for you that's both entertaining and informative, and I hope you enjoy it. So I just wanted to give a quick shout out to everybody that's subscribed, everybody that's joined the Patreon. I really do appreciate the support. Now, having said that, let's go ahead and jump right in. Like I mentioned, I'm buying a lot of Apple stock. It's my biggest holding in my portfolio. It currently makes up about 12% of my portfolio, and I'm probably going to make it around 15%. That is a big portion of my portfolio to have one holding as 15%, but with a company like Apple, I feel comfortable doing that. Now, let's first go ahead and look at just some top news items. We know that Warren Buffett purchased Apple a couple years back, $30 billion of it, and it grew to be worth almost $100 billion, maybe over $100 billion, but he recently trimmed his position. And a lot of people say, well, Warren Buffett trimmed his position. That means it's not a good time to buy this company. I disagree. I think that it was a mistake for Warren Buffett to trim his position of probably the best publicly owned company that he owns. And Charlie Munger, Warren Buffett's right-hand man, told him not to sell. He thought it was a mistake to sell. Warren Buffett said trimming the Apple stake was, quote, probably a mistake, and Charlie Munger told him not to sell. So this wasn't some type of unanimous decision where they all thought it was a great idea to sell Apple or to trim their Apple position. Warren Buffett wanted to, Charlie Munger told him it was a mistake, and Warren Buffett said it probably was a mistake. He said Charlie was probably right. In this instance, I agree with Charlie. I think it was a mistake for Warren Buffett to trim his Apple position. Now let's go ahead and look at some of the most updated information on Apple. The story with Apple all the time is that the company is going to slow down its growth, that it's not going to keep growing, it's not going to keep expanding, it's simply too big, it's too saturated, and it's not going to continue to grow. That has been the story of Apple for the past 15 years, but yet this company continues to grow. Apple reports another blowout quarter with sales up 54%. It authorizes $90 billion in share buybacks, and Apple raises their dividend by about 7%. Apple's growing. In fact, they're growing quite fast. This 54% sales growth from this quarter to the same quarter last year is better growth than Google, than Amazon, than Facebook, than Netflix, than Spotify, than Adobe. It's better growth than a lot of other leading tech companies. 54% growth is massive. And Apple, as usual, exceeds the expectations of the sell-side Wall Street experts, right? The analysts. Apple reported a blowout quarter on Wednesday, announcing company-wide sales up 54%, higher than last year, a significantly stronger profit than Wall Street expected. Every single one of these categories beat expectations, and in most cases by a very large margin. But even despite those numbers, the narrative stays intact, that Apple is not really going to be growing in the future. It's going to have tough comparables. It can't continue with this momentous growth, right? Over the past month, even with this earnings report, it's only up 2%. barely even budged. In fact, year to date, Apple's up 0.9%. The company's mostly flat. In fact, Apple currently trades at a 25 forward PE ratio. If you take away their cash on hand, their massive amount of cash, and you add that as if you're buying that when you buy the company, it's trading at a 23 PE ratio. A 23 forward PE ratio for Apple. Now keep in mind that the S&P 500 on average is trading at a 23 PE ratio, the exact same PE ratio as Apple. They're at the same price. You can buy Apple for the same price that you can buy any average company in the S&P 500. So the first question I have, is Apple an average company? Does it deserve to be trading in line with the rest of the market, not having any type of expanded multiple for a company of this quality, this caliber, this type of moat, this type of growth opportunity? No, it's trading at the exact same multiple as the rest of the market. In fact, we can do a couple comparisons to show you how discounted Apple really is right now, how flat the valuation is. We know that Apple is trading at a 23 forward PE ratio. We can compare that to McDonald's. It's a decent company, but it's not really growing. In fact, McDonald's over the past few years has been mostly flat. The revenue growth is kind of flat, and McDonald's is trading at a 27 PE ratio. It's trading at a higher multiple than Apple. McDonald's is a more expensive company based off its future revenue than Apple is. Investors are pricing McDonald's as a more expensive company. We can look at the Clorox company. Sells some basic consumer goods, the revenue is mostly flat, and Clorox trades at a 23.6 forward PE ratio, which is about the same as Apple. So investors are pricing Clorox at the same multiple as Apple. We can look at Coca-Cola. It's trading at a forward PE ratio of 25, while again, Apple's is at 23. Investors are pricing Coca-Cola at a higher price, a higher multiple than Apple. So again, Apple's trading at around the same PE ratio as the rest of the market, just the average PE ratio for the S&P 500, and it's trading behind companies like McDonald's or Clorox or Coca-Cola. You can ask yourself the question, do these companies deserve a higher multiple than Apple? Does Apple deserve to be trading at a cheaper price than Coca-Cola, Clorox, or McDonald's? My opinion is no. Apple doesn't deserve to be trading at a lesser multiple than these companies. But regardless, the narrative remains the same. That Apple's not going to continue to be able to grow in the future, and they deserve to be trading at a lower multiple than companies like Coca-Cola or McDonald's, right? That's the type of narrative that we've had. And I think this is wrong. A lot of things have happened over just the past couple years with Apple. In fact, I did a video in 2019, March of 2019, so this was actually episode 13, where I drew this really terrible drawing of the Apple tent. And what I did was I compared Apple to the stakes in the ground and the tent as an average customer. Now, the purpose of the stakes in the ground is, of course, to hold the tent up, to make it so it doesn't blow away if you have a windstorm, to make it so the tent stays securely on the ground. If you have just one stake, if you have just the iPhone, then that tent could probably easily blow away. It could pry out that one stake if there's enough wind. But once you start introducing more and more stakes, it becomes increasingly difficult for the tent to get blown away, or i.e. the customer to move to a different ecosystem. Apple has the iPhone, which is one big stake in the ground, but they also have iMessage, and people want to be included in those nice blue bubbles, right? So they have the iMessage, but then they have the iPad, which is 3 stakes now. Then they have the iMac, they have the MacBook, they have the Apple AirPods. Everybody has their AirPods. Those really work best with Apple devices. In fact, all of these devices work best in the Apple ecosystem. But they didn't just stop with the MacBook, the iPad, and the AirPods. Now they have the AirTags. One more stake in the ground that's going to keep Apple users in their ecosystem. They have Apple Music. They have the Apple TV devices that people have underneath their TVs. And they have Apple TV Plus. They have iCloud hosting. They have so many lock-ins for the customer, so many stakes in the ground that customers cannot leave the Apple ecosystem, even if they want to. Everybody that buys another Apple device is further entrenched in their operating system and less likely to leave, making competitors have an increasingly difficult time prying away an Apple customer. Competitors basically have to work with Apple, not against them. Apple, in my opinion, clearly has an incredibly large moat, probably one of the biggest moats in the world in terms of businesses. Users have a difficult time leaving their ecosystem, and every additional device and service they offer keeps them further locked in as lifetime customers. But the experts still disagree. They don't think that Apple has a good moat. In fact, the Morningstar analysis currently is that Apple has an economic moat that's narrow. They believe Apple has a narrow moat. I think that is a laughably bad take on Apple's moat. Even popular tech YouTubers like Marquise Brownlee acknowledge that Apple has an ecosystem that keeps their customers locked in, and they make it incredibly difficult to leave. 3 years ago, he did a video called The Apple Ecosystem Explained, and he talks about the Apple Walled Garden. And then just a week ago, he comes out with another video called Apple versus the Paradox of Choice, where he shows how Apple kind of seems like they're giving customers choices, but they're really not. They're not giving customers that many choices because everything has to work within the Apple ecosystem. And so competitors have no way of breaking this moat. They are locked in as customers for life. I think Marquise Brownlee, as a tech YouTuber, being familiar with the ecosystem and studying these products, has a better grasp on Apple's economic moat than the Morningstar analysts. And I think that Apple has significantly expanded their moat over the past couple years, introducing new devices like the Apple AirTags, pushing out new services like Apple Music and drastically improving that. The Apple Card, although it might not be a big moneymaker for them, it's one more thing. It's one more stake in the ground that keeps customers locked in as lifetime consumers, because it's annoying to have to change credit cards. And so that's just one more annoyance of moving out of the Apple ecosystem. Every one of these products, whether it's the Apple speaker, the watch, the TV, Apple Music subscriptions, and getting your library in there, everything keeps you locked down as a customer. In my opinion, right now, Apple has one of the largest moats in all of the equity market. So we know that I like the moat of Apple, and I think that they have a much bigger moat than the analysts are giving them recognition for. But let's go ahead and talk about the valuation of Apple and the growth. The growth of Apple is what everybody seems to have an issue with the long-term narrative that Apple won't continue to grow. And the price of Apple has gone up. The multiple has gone up. It's gone from averaging around a 16 to 17 forward PE ratio to right now being at a 25. It went up pretty high to like a 30 at one point, but then after the earnings and their future growth prospects, it was taken back down to a 25. So is Apple still growing, and does it deserve this 25 PE ratio? Let's go ahead and talk about that for a minute. Here's a bar chart showing Apple's quarterly revenue growth. This shows quarter over quarter how much money Apple made in revenue. And what you can see is something that investors don't really love. They look at this and they think it's a little bit sporadic. There's sales cycles. They have to sell these expensive iPhones like once a year, and that bumps up one quarter. And it's kind of undependable, right? It looks a little sporadic. It doesn't look like a nice linear line going upwards like a lot of different software companies. You can look, for example, at the previous quarter. Apple revenued $89 billion in the past 3 months. $89 billion. Compare that to the same quarter of the previous year, and they revenued $58 billion. So they increased their revenue over 50% year over year, but most of that is due to the iPhones, this blue part of the chart. The iPhone revenue went up substantially. So like I said, looking over this quarter over quarter looks a little sporadic, and investors don't love this type of revenue line. But if we dig in a little bit deeper, we can see that some parts of Apple are consistently growing on that nice linear revenue stream, especially the green part, which is the services of Apple. This is the next big portion of this company that will continue to grow. In fact, if we cross out the rest of these and just look at the services, you can see what I'm talking about here. This is just the subscription side of Apple, just the services, and you can see the nice, consistent growth. This is substantial growth from 2017, going from $7 billion to 17. That is massive growth over only 3 years. Apple's services are becoming an enormous part of their revenue. In fact, in just the last quarter, they revenued almost $17 billion in services. We can compare that to some other companies just to give you a quick comparison. For instance, the entire year, not just the last quarter, but the entire year of 2020, Adobe earned about $13 billion in revenue. So Apple's services business alone revenues more in 1 quarter than Adobe's does for an entire year. We can even compare Apple's services to Netflix's entire revenue. For 2020, Netflix revenued $25 billion. Apple is almost at the point where they're going to be passing Netflix's entire annual revenue in 1/4 of their services. And like I've repeated many times, I think this services is going to be a bigger and bigger portion of Apple's revenue, and it will help them justify trading at a higher multiple, because investors love the type of subscription service revenue and the stability that that brings to the earnings of companies. So although if we add in the other revenue sources, the services are still a kind of smaller role. They play like maybe 20-30% of Apple's revenue. It's growing steadily. It's becoming a bigger and bigger portion of Apple's revenue, and I see that trend continuing in the future. In fact, I don't think the markets in general, and especially retail investors, are acknowledging how quickly Apple is growing their services business. And I can't stress enough how important this type of revenue is. The yearly subscriptions, the monthly subscriptions, that annuity-like income that's dependable and can grow over time and keeps customers locked into your products, it is the most sought-after type of revenue. I've done video after video explaining how subscription revenue is the most sought-after type of revenue because of the attributes it brings to different companies. Companies like Microsoft enjoy this type of revenue, and that's why they trade at higher multiples. But Apple is growing this revenue incredibly fast. They currently have 660 million subscribers. Not just users of their products, not just people that bought iPhones or iPads, but subscribers. People that are paying for things like Apple Music, Apple TV, Apple Arcade, Apple News, Apple Fitness, iCloud, so on and so forth. One of these services. They have 660 million. They're growing their service revenue by 27%. And Apple has an incredibly easy time gaining customers. Their customer acquisition cost for these subscribers is incredibly cheap because they're already in the ecosystem. It's an easy decision to sign up for Apple TV or iCloud because you already have all of their devices, and these services work so well with their devices. Apple's also gaining new subscribers rapidly. In just the past quarter, the CFO noted that Apple gained 40 million new subscribers. In the past 3 months, they gained 40 million new subscribers. Netflix, for instance, over that same time period, gained 4 million new subscribers. Apple gained 40 million. But yet this isn't really like a headline part of their report. It's not that reported that Apple's growing their subscription business 40 million subscribers every 3 months, and the 27% revenue growth of their service business, well, that's faster than most service-oriented companies like Spotify, Netflix, or Adobe. So they're not only growing the amount of customers every single quarter, but they're also growing their revenue rapidly, in line or better than most service-oriented companies. Now, having looked at all of that and seeing the rapid growth of Apple's services business, growing its revenue 27% year over year, growing the amount of subscribers 40 million in the past 3 months, and the expansion of their moat, adding on more products, more services, keeping customers more locked into their ecosystem, I want to just loop back and remind you that Apple is trading at a cheaper price than McDonald's. McDonald's is a fine company. I think it's a good company. But does McDonald's deserve a higher multiple than Apple? Does McDonald's deserve to be a more expensive company based off of its revenue than Apple? I personally don't think so. Now, there's a couple more things I want to look at with Apple as well. We know that they made a pretty big move becoming a chip maker. That's interesting. Not every company can just become a chip maker, but Apple moved away from Intel and they created their own chip called the Apple M1. And they're putting that in Macs. And I want to show you the reception that that chip has had. This video, for instance, has 7 million views. It's again with Marquise Brownlee, and he's going to give you his honest opinion on the performance of Apple's home-built M1 chip.
We kept seeing numbers like 3.5x better CPU performance, 5 times better graphics performance. Those are also some pretty steep claims. So for measuring real-world performance, a lot of people start with benchmarks. So I did too. I actually tried Geekbench before it was updated for Apple Silicon and got this score, which already puts it above every laptop they've ever made in single-core performance and right around the 8-core Trashcan Mac Pro for multi-core performance. Then it was updated for Apple Silicon, and so I ran it again, where it proceeded to annihilate the other tests, posting 1744 on single core, which is faster than every Intel Mac ever made. And the multi-core score of 7600 put it up with the 8-core iMac Pro, so above all of the other highest-end laptops.
The claims that Apple made with their new M1 chip were very bold, and it made a lot of reviewers like Marquise Brownlee and different tech reviewers skeptical that Apple would really be able to live up to their big claims. But every single test shows that they have. They've lived up to it. Even though people didn't think they could make this big of a leap from one chip to the next, Apple has. and other competitors can't compete against this. Good luck trying to beat the performance of Apple's M1 chip.
But just beyond Geekbench, like using this thing daily in macOS Big Sur, all of Apple's native apps, especially Safari, are really fast. Animations are buttery smooth, as you'd expect, and even opening and closing some of those bigger apps like Chrome and Lightroom are just as fast, if not faster, than on my desktop, which is sick. It's just an overall really responsive feel.
That is the type of reception that Apple has had with their new M1 chip. Outside of the incredible performance of Apple's new chip is the improvement in battery life. This is another area where others can't compete with Apple. Listen to how much this new chip improved the battery life of Apple's new laptops.
This MacBook Pro has been amazing. So Apple is claiming they basically doubled the useful battery life in this laptop without changing the battery size, which is pretty unreal. Like, you never really see battery jumps that big. But the truth is, yeah, this is now an absolute battery champion. It might not double in every use case, maybe just the most efficient, most well-optimized use case, but I took this laptop out the box and set it up while charging to 100%. And then I didn't plug it in for 4 days, totaling a little over 10 hours of mixed use.
He didn't have to plug in his laptop for 4 days, and he got over 10 hours of battery use. And keep in mind, that's the same size battery that they had in the previous version. All this improvement is a result of their new chip. Now, I've talked before about how in a lot of people's minds, they still consider Apple a device maker. It really hasn't set in that Apple's not just a device maker, they're a healthcare company. They have Apple Fitness. They're getting people in shape. They have the Apple Watch, which gives people readings on their vitals, on their heart, right? Their heart health. Apple is a healthcare company. We also have Apple being a game maker. They make video games. They do it through a cloud-based system, a subscription service, where you can play it on your Apple TV, or you can play it on all your different devices. And they're also an entertainment company, coming out with original shows, original movies. And this is a small portion of their business right now. They have a small library, but they're going to continue to grow this. They have some really big, epic series coming out, like Foundation. And Apple is a fintech company, coming out with unique ways to control your finances. So we know Apple has been a media company, a gaming company, a fitness company, and a fintech company, but it now seems like they are a chip maker, a serious chip maker for all of their devices, and a really, really good one. Their new M1 chip has had universal praise, and this is one more step in the right direction for Apple. And those are just the businesses that we know about because they've already been made public. But we also know that Apple continually works on new products in the background, investigating new products that they want to bring to market. One of them is Apple Glasses. This has been something that they're heavily rumored to be working on, and it could come to market in 2022. It'd be an augmented reality headset or glasses that would integrate with the Apple ecosystem. We also know that Apple is working on an Apple car. They say that hundreds of employees are working on developing a self-driving Apple-branded car aimed at customers. We don't know many details about this, but Tim Cook indirectly said that they are in fact working on an Apple car, and so this is something that they're heavily investigating. This isn't guaranteed to happen. Maybe they won't come out with Apple Glasses or the Apple car, but there's things like this down the line that could change the needle for Apple a bit. If they did announce an Apple car, that could be a pretty big game changer for their company. Those exciting products that might happen are a result of Apple's enormous research and development budget. In fact, Apple spends over 3 times the amount the average company does in the S&P 500 on research and development, and they consistently and steadily increase their budget on research and development. This is the sign of a good tech company, one that can put money to work back in its company to research and develop new products for its consumers. Just imagine for a minute if Apple released an augmented reality glasses, or if Apple announced that they're coming out with an Apple car. What would happen to the stock? What would people think of an Apple car? I think they would have a significant advantage, and their biggest competitor would probably be Tesla. They'd be the biggest competitor, but I think it could be a big game changer for Apple. So what I figure is that right now I'm buying a solid company, even if these things don't get announced, even if they don't come to fruition, if Apple says, you know what, this isn't our business to go into augmented reality or to come out with an Apple car, we don't think it's the wisest decision, we still own a good company with Apple. But if Apple does announce these type of products and they really believe that they have a chance of success with them, I see that as only an added benefit, only another thing to add value to the Apple ecosystem. Now let's go ahead and address one of the biggest concerns for Apple investors, the big bad case with Epic Games. This is where Epic is complaining that they can't have multiple app stores in the Apple iOS ecosystem, and that Apple charges an unfair fee. What I think will happen with this case is, first of all, I think it will drag on for years. It's not going to be something that's solved right away, but I think that Apple is going to lower their fees. I don't think they're going to allow other stores to be installed, but they will lower their fees, and I think Apple has already calculated that in. I think they know that eventually they're going to have to charge less and less in their store, maybe from 30% to 15%, and then from 15% to 10%. And even if Apple does that, they're still going to grow their service business. That is one part of their overall service business, and I think they'll continue to grow it substantially. So in my opinion, this whole case is a big non-issue for Apple. Even though they're making it out like it's a big case, I think that right now Apple has already made the determination and the calculation that they're eventually going to have to lower their fees, and they found ways to grow their business regardless. So there you go. That is my bull case on Apple. That's the reason that I'm investing in it. I see it as a company that is trading underneath a lot of other companies that I think are less deserving of that multiple. Apple has a lot of growth ahead of it. I think it will expand its market share. It'll expand its revenue. It'll grow its service business. And I think it has substantially grown its moat over the past couple years. And I think the professional analysts, they don't get the moat right with Apple. So in my opinion, I see this as a company that will see both capital appreciation and dividends over the long-term future. And I think it's a better deal than a lot of other companies in the market. Now, having said that, this company isn't perfect. Stories can change, things can happen, and you're subject to risk with Apple like you are with any equity investment. So keep that in mind when you're making your investments. For me, I continue to invest in Apple. I'm making it a big portion of my portfolio, and we'll see how that goes. So I hope you enjoyed this little update on why I'm buying Apple, what I'm doing with my money. If you did, consider giving this video a thumbs up. And if you aren't already, consider subscribing to the channel, because I have frequent updates like this with this portfolio all the time. So I'll be showing you what I'm buying and selling in the future and giving my thoughts on different news. And if you want to bring your membership to the next level, you can consider joining the Patreon. There's a link in the description. Other than that, I'll see you in the next episode.